About 2 years ago, ECA started the Supplier Council, whereby we invite our suppliers of natural gas and electricity services to participate in our biannual meetings, seek opportunities to exchange policy perspectives, and to learn about the products and services that they offer. And with that in mind, today we have E&C Consultants as a guest speaker. Now I would like to turn it over to Kobe from E&C Consultants. Go ahead, Kobe.
Thank you, Paul. Thank you for the introduction. Good morning, everybody. Thanks for joining this webinar. I hope you can all follow the presentation. Let me just start with telling you how the webinar will be built up today. So essentially, we have two separate sessions. One will consist of me bringing you a presentation, a very brief presentation on risk management. The other part will consist of an interactive part of a Q&A session. Now, if you have questions during my session, you can type them in the chat box, and they will be immediately addressed in the Q&A session. Of course, during the Q&A session, there is also the possibility to interact with me. Therefore, you can use the raise your hand option, and when your hand is raised, the moderator will give you the floor to ask your question live to me. Today's presentation has three main building blocks. I first want to talk to you about the energy markets. Secondly, I want to give you a very brief insight into a risk management approach on how to deal with these, all in all, volatile and uncertain energy markets. And all the way in the end, very briefly, I want to introduce my company to you in the last session. Again, after these three building blocks, we will follow with a Q&A session. Between my presentation and the Q&A session, there will be a poll allowing me to gather the questions, and you can answer that poll, and I will then discuss the results of the poll. Let's first start to talk about the energy markets. As you all know, the energy markets in itself are a very volatile environment to be buying your commodity in, as many other commodity markets, of course, but the energy markets in particular have a very volatile nature. Let's look back for a while. Let's look back 14 years now, and this is the natural gas price the month ahead on the NYMEX. You see that there's been an enormous volatility in this market. We are talking about a factor 8. Prices were as low as $2 per MMBTU on different instances. We look back to the years 2000, 2001, but also 2012, and even recently we weren't too far from that, but also as high as $16 per MMBTU on the month ahead. If we look back only 7 years, so zoom in 7 years on the same graph, you may think that we're on a long slide down at this moment, because since the last peaks that we witnessed in 2008, when there was a global boom in the commodity markets, followed by a financial crisis that everybody knows about, it looks like we're on this one big slide down, sometimes creating a feeling of buyers that it's better not to do too much in this market, because the waiting game is the rewarding game. But is that really so? When we look only 3.5 years back, so again, zoom in a little bit closer, well, the slide down isn't that much of a slide down, is it? When you really look up close, of course, we all know what happened in 2014. The phenomenon called the polar vortex pushed prices up really high, only to fall back again afterwards, with even last winter passing really unremarked, even though, again, we had record cold temperatures. As such, indicating that there is enough gas currently being produced and enough gas in the system. But then you see my question mark. What will this near-term and long-term future bring? And of course, no one is there to really know. I want to bring you a couple of elements that that can play on creating a vision for the near-term future. First of all, let's have a look at a very remarkable correlation between the year 2012 and the year 2015. Starting in the winter of the year before, when you look at the evolution of the 12 months strip that traded back in 2012 and how it trades right now, you see an extremely big correlation between those two. Of course, driven by different circumstances back then and now, but the trend itself is remarkably close. And if you see what happened in the second part of 2012, while prices picked up from as low as $2.50 per MMBTU to as high as $4, so nearly doubling in price. Question mark, is winter coming again this year or not? We'll witness this in the second part of this year. One of the factors that is currently making prices low, but also potentially pushing prices up in the second part of this year or later, is the rig count decrease by in different shale deposits. Most of that is due to a decrease, an enormous decrease in the oil price in the second half of 2014, dragging down production activities in the oil fields and equally in the gas fields. Remarkable to see, though, is that even though this rig count is down heavily, the output isn't really affected yet. It's not to say that it will stay unaffected, but at this point, the output is still going up. We had a couple of months in the beginning of 2015 where we saw a slight drop in gas production, but currently we cannot really speak about a very big trend reversal. That is your dark blue line. That just hints at a very big gain in efficiency of those existing wells. Another point that is shedding some doubts over the near-term and somewhat longer mid-term future is the construction, the ongoing construction of big LNG liquefaction projects around the United States. And I've just summed up a couple here. There's at least 4 to 5 that are currently under construction. And the first one there, Sabine Pass, trains 1 to 4, is normally going to be operational as soon as next year, early next year. If you look at the capacities that these under construction terminals will be able to produce in LNG on a daily basis, we talk about roughly 8 BCF per day of capacity once they're all up and running. You have to put that in the frame of a national production of 70 BCF per day. So that's a pretty big share of the natural gas production, current natural gas production. Of course, the future one will be higher as well. Can be transformed into LNG and then, of course, shipped to other parts of the world. You have to know that gas producers themselves were the last to wait for such a low gas price. So in itself, they are looking logically on their behalf for new markets to sell the product at premium prices. Another thing that will potentially drag some gas away from the US market is, of course, the ongoing improvements and constructions into the Mexican infrastructure. Mexico is in the process of deregulating its energy markets and is allowing more and more free competition in the country. And as such, there is an expectation of increased natural gas exports, pipeline exports towards Mexico. They even build an LNG terminal as well to receive natural gas, or even two. A last element that I want to talk about is the coal to gas switch that is ongoing. And here you see the electricity generation by fuel as far back as 2004 all the way to January of this year. And you see that the trend is very clear. There is definitely an increased production from gas-fired power stations, and there is an even as remarkable decrease of power production in the coal-fired power stations. This is partly driven, of course, by the low gas prices, but also partly driven by something that most of you know, which is the Clean Power Plan. That is not yet in implementation. As you all know, this year, the final rule is due, and then up to 2030, there is a whole process that will start, and that has to be implemented state by state. Here you see the building blocks, but you see that a big part of the building blocks of reducing emissions is caused by the switch to natural gas. So again, this is an extra element that is creating uncertainty as far as the gas markets are concerned, and of course as far as the gas price is concerned. Now, after giving you some bullish and bearish elements that could play on the energy price in the near future, I want to take a brief moment to discuss what are the typical pitfalls of buying energy. And some will be recognizable, and you will see that most of them are actually driven by human psychology. We're all humans after all, and we have this role of buying energy for our companies. The first one is, in an uprising market, you see that many people suffer from a degree of wishful thinking. This will all pass. Before I need to take a decision, markets will cool down, and I will have the ability to buy at better pricing. When markets keep on rising, and those who were buying already energy in 2006, 2007, up to 2008 know what it feels to be buying in an uptrending market, then very often panic is installing decisions that aren't, in hindsight, the best, of course. You cannot open your newspaper anymore without reading that oil is going to hit $200 before the end of the year. So in a panic mode, people start to fix energy prices. That's another big pitfall. A third pitfall is, in a decreasing market, out of fear of missing the opportunity of lower prices, people start to buy too soon. And so they fix in different times, but they fix portions of their energy in a decreasing market. A last important pitfall is that at the real turnaround of the markets, when we hit interesting levels and markets start to trend up, out of greed or other mechanisms, people forget to buy enough. And so if you have a parcours like this and you buy your energy in this way, logically, you will not even beat the market price. And your resulting price will be much higher than the market price, shedding some doubts on whether you should even actively try to buy your energy and not just float it on the markets. Now, how to avoid them? That's the answer. When we have the answer to these questions, we also know how to set up a risk management approach. And it's fairly simple. You just start the other way around. First of all, at the time of the turning of markets, buy enough. So you need to have systems in place that at least detect that opportunity when it's a good moment for you to buy your energy. So fix enough when the markets turn around and when they hit historical low points. Secondly, have sound tactics in place that prevent you from buying in a falling market, because we know that when you buy in a falling market, of course, your average price will be dragged up. Thirdly, and also very importantly, is have a stop-loss strategy in place before markets are in a bullish environment and keep on trending up, so that you can fix, because you know that you want to fix your energy before you hit your stop-loss. If you apply these principles in a very sound manner, often, not always, but often your resulting price will be lower than the market average price, creating a rightful place for you to actively manage purchasing your energy. Now, in the 15 minutes that I have left, let me very briefly introduce you into the most important principles of risk management. First of all, risk management, what does it really do on the long term? In lack of being able to forecast what energy markets are going to do, the only real thing that we can do is decide the pace at which we will take the ups and downs of the energy markets. We cannot say that within 2 years the energy price is going to be at $6 per MMBTU and therefore know that we have to buy all of our energy for the next 2 years right now at $3 per MMBTU, but we can prevent our price to become 6 by buying in time. So pretty much the pace at which we take the volatility of the energy markets is something we can still have a degree of control over. In setting up an energy procurement strategy, we determine 3 important steps. The first one is very important. It comes down to determining your risk profile as a company. The second step is determining the tactical hedging tools that you will use. There are many different ways of buying energy, but you have to determine which ones are a better fit for the type of strategy that you are going to follow as a company. A third step is edit a strategy note. We think it's majorly important to write down the rules of engagement, so to speak, to write down the rules of buying energy, have that discussed with the board of the company, and have them approve those rules, so that later on, depending on what markets do, you can go ahead and buy the energy within the rules that you've defined with the board of the company. Otherwise, you'll be forced to constantly take ad hoc decisions, which of course in hindsight can always be wrong or bad, but nobody will take responsibility for them. Now, in setting up your strategy, it is very important to determine your risk profile as a company. We hear that sometimes that determination of the risk profile is done by a questionnaire, where pretty much the board of the company is given out a questionnaire, and that comes down to deciding whether you're an aggressive or a defensive investor almost when you buy energy. In our view, that's not the right approach. It isn't down to the risk appetite or lack thereof of the board members on how you should buy your energy. It really comes down to what energy price volatility does with the bottom line of your company. So you have to ask yourself the first very important question. If the cost of energy is falling, does that lead, with or without lag times, to a falling price of the product that I produce? If the answer to the question is yes, well then clearly there is a direct link between what it is you produce and the energy prices. And then you will find mechanisms to de-risk that. Either you will have found energy clauses in your sales contracts with your customers, directly transferring the price volatility of energy towards your own customers. If you haven't found these, then you will find other mechanisms to make certain that the energy price, the average energy price that is relevant for your company, is also being procured by your company. If the answer to the question is no, if there's no direct correlation between falling energy prices and your product price, or the other way around, increasing energy prices and the ability to increase your product prices, then there's a second important question you need to ask before determining where you are. The second one is that energy budget that you each year have to buy, those X million dollars that you spend on energy, what proportion does that budget take of the margin? And if the answer is yes, it's actually equal to what we make as a margin each year, then you know you're in a very difficult situation, because the energy markets have the ability to double just over 1 year time, which means that if you float all of your volumes on the market and you haven't secured any energy prices beforehand, you will pay a double energy price the next year. But if you haven't got the ability to pass on that increased cost to your product price, then of course your margin for that year is gone. So pretty much buying energy in that situation becomes almost part of a survival risk strategy. If again your answer to the second question is no, well then buying energy is really a budget risk question for your company. It means that energy in itself is not defining the profitability of your company, but it's a large budget altogether, and it's better well managed than just left unattended. If you see on the axis between, on the one hand, doing nothing at all and floating all of your prices on spot markets, and on the other hand, just buying energy on fixed prices on arbitrary moments at one point before delivery of that energy, then there is middle ground as well. And middle ground is what we call risk management. It's never just fixing the prices accidentally almost at one go, nor is it just floating your prices either. While floating your prices can of course be a right strategy if you're in the market risk corner, but the risk management approach really comes down to defining which is your best approach and choosing your instruments for preventing the worst to happen. You will see that independently of which category you fit in, whether you are market risk, budget risk, or that very difficult category in the middle, the survival risk strategy, you will always follow the same principles of a good and sound energy procurement strategy. One principle that each of us know is buy the dips. It means that buy when markets are low. Don't forget to buy them. As I was saying, that is the solution to the fourth pitfall when you buy energy. But depending on where you are with your company, you will have a different attitude towards this principle. If you're budget risk, you can definitely layer in hedges even right now and make certain that the future will hold some of the currently low, historically low prices for you when that energy gets delivered. Clearly, when you're market risk, you're much more careful with those opportunities because there is no guarantee that the current $3 per MMBTU forward price for Cal 16 is going to be beating the average market price of 2016. So you need to be careful there. But again, you can use the forward markets related to the impact of the energy price volatility on your product price in that case. A second principle is buy at intervals, whether regular or not. That's again depending on the needs. But spread out your buying moments. Do not just go in the market and buy everything at one day. It's like going to a casino with all of your money and putting everything on, say, black 22 and hoping that that is the number that will come out. But put your money on as many different places as possible, so at least to enhance your chances of winning something. A third principle is have your maximum year-on-year increases defined, so that you don't run into problems when markets start to increase and that you know what to do. And typically, budget risk strategies will allow for much smaller percentages of maximum allowed year-on-year increases. With market risk, again, you need to be very careful applying these principles. Now let me explain you a little bit how this incremental price lock technique actually works and how it can be effective for your company. First of all, the main principle here is to disconnect the moment of contracting from the moment of buying. Now this may sound like a strange phrase for many, because isn't contracting the same as buying? Well, of course it is. But what we mean is that at the day of contracting your energy, you do everything. You arrange who you will buy your energy from, you choose your supplier, which is part of an RFQ that you run. You arrange everything, you arrange all the conditions at which you will be buying your energy in the future. You arrange the margin that the supplier will earn by supplying you with energy in the future, but you do not lock the price yet at the day that you make your contract. So you pretty much make a hybrid flexible contract, allowing you to purchase afterwards. Of course, when making such a contract, what is crucial is the rules at which you will be able to layer in those hedges later on. It needs to be done transparently so that the supplier that you sign with cannot just run away with any type of price quotes that they're offering you later on. But there are all the possibilities to do so in an extremely transparent way. Then the energy price starts to develop. You've contracted for the next 2 years, and you have the ability to layer in hedges according to what happens in the market. Layer in your first hedge on your next year's volume. Markets go further, next opportunity. You can layer in a next hedge on your next year, but also start with the first hedge on year +2. This allows you two things. First of all, markets are opportune to buy. Secondly, by layering in hedges over more than just 1 year and incrementally, you also stabilize your costs for the future. So you try to achieve two goals at the same time. Markets develop further, a next hedge is executed. Then when the next year arrives, you want to extend your contract again so that you're able each time to buy 2 years ahead. So you need to do some contracting, and your third year can now also be procured. And then again, you start to do so. So pretty much with every rolling year, you contract the next year so that you're able to incrementally hedge your volumes, and so forth and so forth. There are many different contract models out in the field. I will not go into the details right now, but each have their merits and also their downsides. Again, a contract for us, in essence, is instrumental. It needs to allow you to execute your risk management strategy and not the other way around. Sometimes people go out, they find some kind of flexible contract, and then they think about the strategy they can execute with it. We think that's a mistake, and you should turn that around. First, think about your needs, your strategy, and then go on to buy the right type of contract. A block model contract has its merits, but you will have a cash-in, cash-out principle based on the spot markets. You also have load-following contracts. They are more expensive, of course, because in such contracts, you are not buying absolute volumes through your supplier, but you're buying parts of your profile, your future profile, with some kind of bandwidth on that. So the supplier will ask you some more money for this because your profile isn't traded in the markets, of course. Now, as I said, it is very crucial to have your opportunity detecting mechanism in place. And ENC has developed a methodology in lack of being able to forecast and in lack of being able to say exactly where the energy markets are heading. There's one thing that you can do, that is just looking back. You can say that the current future price compared to 3 years in the past currently trades high or low. And depending on whether it trades high or low, you can actually predetermine how much you will buy. And this is what you see in this example. You can see that in this type of customer has predefined that when energy forward prices reach very low percentiles, so percentiles lower than 10%, meaning that the forward prices are amongst the 10% best traded prices over the past 3 years, including the spot market prices, well, this customer allows himself to buy 100% for year plus 1, 75% for year plus 2, and even 50% for year plus 2. Extremely budget driven, but that is a possibility. So this kind of scheme, this kind of framework, you can drag along over time, and you don't need to define when you're going to buy. The markets will define it for you, but you have defined, predefined together with your board what the maximum allowed percentages of coverage are. And of course, again, those maximum allowed coverage percentages will really depend on which type of strategy you want to execute with your company. The second main element is your risk management. Be certain to be monitoring at each point in time where your portfolio value is heading. Portfolio value, of course, is the combination between positions that you have taken in the market and your open volume at market price, and have your risk limits defined up front, so that when you're running up, the markets are running up and dragging up your portfolio price, you know how much margin you have left before you need to take that decision. And what we typically do is we calculate value at risks, showing you when your risk is going through your predefined stop loss limits, allowing you to take action in time. So before your portfolio price hits your predefined stop loss limit, we start to buy as to prevent hitting a stop loss limit. We prefer to work with variable year-on-year maximum increases and have these percentual increases and have these approved by the board, rather than prefixing some rounded numbers. Say, some time ago, maybe $5 per MMBTU was a good stop loss level, but what does it really do for your company right now when we're at 3? So we have actually a methodology where we say, well, why don't you say the maximum year-on-year increases, and also do that for the full contractual horizon, which means that if your average price for 2014 was $4 per MMBTU and you've defined a maximum level of 10% more for the next year, well, then you know that you have to stay below $4.4 per MMBTU for 2015 as not to go over your predefined stop loss limit. If you realize a price of 3 this year, then your stop loss limit for next year, for 2016, will become 3.3, being very ambitious again. So you basically guarantee your company that there's a maximum increase year on year, and on the other hand, you lower it when you're doing well. Of course, all of this can only be successful when you have very good and sound KPIs and SLAs in place. And these are a couple that we typically monitor for our customers when they work with us. But the main KPIs and SLAs that we can think of are deadline compliance, of course. Strategy compliance, very important. It doesn't make sense to write out a strategy note if you're not following your compliance with it. Monitor all your savings. Here you see a couple of savings possibilities, saving calculation possibilities that we apply. And make sure that your system, your data management system that you have in place has the right uptime. By the way, for all who participate, this presentation will be made available for you to take your time to run through it. Very briefly, I'm almost over my time, about ENC. ENC is an independent energy procurement consultancy. What does it mean? In this relationship between you as an end user and your energy supplier, we see ourselves here. We see ourselves as a consultant behind you with all that is relevant in information, doing your RFPs for you, but with you involved, and then daily monitoring the markets for you and giving you proactive advice when you need to take those positions. We don't see ourselves as an in-between between you and your energy supplier. We will never ever receive any payments from energy suppliers. We're only paid by our own customers. We have an international company structure. We currently provide services in most of Europe and also in the United States. We are now 10 years old, and we were very successful at building out this international consultancy company. The types of services we bring, as you can see, we've done them in three main categories: share, think, act. Under share, we present our customers with a data management system which we call ePoint, which does everything that it needs to do. It brings you the visualization on what is happening in your portfolio on the markets. It documents everything. It stores all your documents. It's the main tool of communication. The middle branch is where our services come, structured around the word think. So basically our services are structured around risk management, making that strategy together with you, and then applying it by monitoring the markets on a constant basis. Of course, we help our customers finding the right instruments, which are their supply contracts. And as a fourth service, we bring all the services related to financial control. With ACT, we mean helping you facilitate the trades itself. So this brings me to the Q&A session. But before we go into this, I want to present you with a poll question, allowing me some time to look at your questions that came in during my session. So Yoko, you can start the poll right now. Thank you. Okay, thank you. Pretty interesting results here from the poll that we asked you. So we did ask you indeed if you classified your company as being more budget risk, market risk, or that middle category, the hardest one to be quite frank, survival risk. The results are all in all what we could have expected, although there are more market risk participants on this call than what you would, I would say, usually find in the field or across the industry. And this has to do, of course, with the nature of AICA itself, being an organization that really represents the very highly energy-intensive users, and they very often are market risk. Very clearly, there is a very big relationship between what happens in the energy markets and what happens in their own markets. 60% almost, 56% in this case, so more than half classifies themselves as budget risk. Again, I think very truthfully, as I was pointing out in my presentation, budget risk in our view doesn't mean that you shouldn't be actively managing your energy budgets. Very often it's still a very considerable amount of money that you spend on energy. And you have all the tools at your disposal to make certain that that amount of money is spent wisely. So we would advise anybody who's in the budget risk category to very actively monitor energy markets and apply the principles of risk management that I was just presenting to you in an as efficient way as possible. Market risk, as those of you, nearly 40% on this call, who answered that they were market risk, they all know that it's about finding the right translation between buying energy and how that impacts your product prices. And again, there are many different possibilities. Sometimes you will have gone as far as to just include in your sales contracts an energy clause, saying that if NYMEX does this or that, we adopt our prices. At that stage, of course, you're de-risking the volatility of the energy price and moving it to your customers, but you're also giving away part of the possibility for your company to benefit from certain circumstances in the energy markets because it's done in a transparent way. Other companies will have found solutions where they buy partly on a floating price, and then they try to make certain that the way they buy it on a floating price is as adapted as possible to how the energy prices impact their sales prices, or sometimes partly also buy based on certain opportunities in the future market, but then limit that percentage that they buy on opportunities to maybe 10 or 20% of their total volumes, as to avoid being completely wrong at any given point in time. As I was saying, survival risk needs a very, very dedicated approach. Buying energy becomes extremely crucial for your company. And in such case, we work with these customers in a very intensive way. We set up a tailor-made strategy, which we do for all, but in this case, even more tailor-made. We really figure out how energy is threatening the company. And we typically engage on a very close relationship with these customers, making certain that that they don't have to undergo any real accidents when locking in their energy prices. Now let me turn to some questions that we received during my presentation. And again, feel free to raise your hands at any given moment in time. Ben Karen, who's on the line as well, who's a consultant for ENC in America, will be the moderator, and when he sees that your hand is raised, he will give you the floor to speak. Basically, when I look at the questions, we had questions in, say, three main categories. Some questions were related to the energy market itself. Some questions were related to our risk management approach, and some were related directly to the type of services that we bring. Let me address the first set of questions for you. Some come down to my own personal feeling about the markets. I've given indeed a number of bullish and bearish factors, I suppose. But in the end, what is my opinion about what is currently happening in the markets? Well, my answer back would be, does that really matter? I can have an opinion as bullish or as bearish as I want. It is potentially not going to help your company with taking the right decisions. Let me clarify this a little bit more. Again, we try to prevent from any type of forecasts to play an active role in how you buy your energy. Energy prices are influenced by a lot of factors. They're influenced by economical factors, macroeconomical factors, geopolitical factors, climate. As we know, climate is one of the most unpredictable things we have to deal with in our daily lives, and so many other factors. So nobody really can perfectly predict the outcome of the energy markets. You can have a bullish sentiment currently with all that is looming out there. Indeed, it feels uncomfortable to know that a lot of natural gas will be transformed into LNG and shipped to other places in the world. It feels uncomfortable maybe that a lot will go to Mexico, and so forth and so forth. But who is there to say that production will not simply keep up pace, and that production will keep on outmatching demand? So again, as we say, try to get away from the natural inclination of forecasting what the future will bring, but have instead a sound set of principles ready that allow you to, at each point in time, react to whatever is happening in the market in time. And so it's crucial to know for how many years in the future you want to be able to react on your future energy prices. And again, that is related back much more to your company's profile than to you as an individual buyer with a certain gut feeling. So this is essentially what we try to do. Of course, ENC does a lot of market analysis. It's not because we don't do market forecasts that we're not constantly looking at what markets are doing. But the market analysis really helps you to say whether today you should buy or whether maybe you can wait another day. But fundamentally speaking, we're looking more at where the forward markets are trading historically speaking, and then looking back at the rules that we've engaged on together with the company, we will have an advice according to those rules and where the markets are trading at. So yeah, my personal opinion is not that important on what the future will bring. I would say, more importantly, have your risk management strategy in place so that you're able to react to whatever is happening. Ben, did we get any raised hands so far? Okay, I don't think so. So I will just continue with the second set of questions. Why do I need to invest in risk management if I completely fall into the budget risk category? Well, I think I tried to explain this really well. Indeed, when you are just falling into the budget risk category, you're not at risk of having the company in real problems when something dramatically happens in the energy markets. But consider the following: you're spending millions of dollars on energy still, and the energy markets do have that potential to just double simply in 1 year's time. Will you just allow your price to double together with the energy markets, where you had the ability to prevent that price to do so? And in the case of you spending $5 million on energy as a budget risk customer, all of a sudden paying 10 millions, whereas you could have avoided paying 10 and could have stayed at maybe 6. So we say that it's not because you end up in the budget risk category that you shouldn't be carefully monitoring your risks out there and have an approach of risk management that can help you prevent the worst to happen. Another question that I got was, can I apply these risk management techniques to other components of the energy bill? Well, that's a very good question, I would say. There is indeed, specifically for power, and by the way, we do buy power in deregulated markets in exactly the same way as natural gas in almost the whole of the United States. But in deregulated markets for power, you find the exact same instruments, the hybrid contracts that allow you a very good degree of risk management. Now, applying these same techniques to other parts of your bill is somewhat tricky. Specifically for power, your bill is composed of much more than just the commodity component. As you all know, depending on the state where you have your activities, there can be a lot added to that same bill. Some of these elements, such as capacity markets, RECs and others, are driven themselves by market mechanisms almost, market mechanisms and or auctioning mechanisms. So there is, to a certain extent, there is this possibility for you as a company to also apply some of those risk management principles to the price developments of those components that will be passed through by your supplier in the end. But that is much more limited than what you can do on your commodity side. And your commodity side still represents the big part of your bill in any case. So again, related back to the volumes, there are possibilities to go and talk to your energy suppliers or negotiate with your energy suppliers the possibility to independently or to lock in prices of some of those components in line with what happens in their markets. But those possibilities are all in all relatively limited. Another question I got was related to what can I do or what can you do for me in regulated states, so those states with a regulated power market, because in most states by now, if you're big enough, you can buy your gas from a third party and start applying risk management principles. But indeed, there are many states with a regulated energy market still for power. Well, there clearly there is a limitation to applying risk management, as your price is not defined by developments in a wholesale market, in a deregulated wholesale market segment. So really what E&C can do and what you can do yourself in such circumstances is making certain that you follow up on the development of regulation really well, that you have good relationships, of course, with the local utility commission, and that you make certain that at any given point in time you're on the right tariff, because there are constant changes to the regulated system as well, and you need to be aware as a big consumer of those changes and make certain that when you have an opportunity to pay less for your energy, you haven't let it pass unnoticed. That's a job. That's the only job pretty much that you can do in such circumstances. One more question I got somewhat related to the risk management approach is: Can I save money? Can't I save money, more money, by investing in energy efficiency and demand response? Well, yes, you can. More, that is something that I cannot say. It depends on the possibilities of your company. Sometimes you can save a lot of money by investing in energy efficiency and demand response possibilities. But for me, it's always an and story. It's never and or. I would say do both, and you will be more happy even if you, together with applying sound risk management to your purchase of energy, together with that have done everything possible in consuming what is left as efficiently as possible, and where possible, see if you can participate in certain demand response programs, then the picture is complete. So never stop with just one leg of the story. Never stop with just focusing on energy efficiency or just focusing on risk management, but do it all together. To be very clear, ENC is a pure procurement consultant. So we typically do not engage in technical programs where we help our customers to consume the energy more efficiently. We do run RFPs for this, though. If your company has a specific need in that sector, there is a whole field out there of market participants that can help you out, and an independent consultant can help you with the right choice in who you should work with in terms of efficiency and for demand response. The last couple of questions that we received were related to the ENC services. Are you operational nationwide or just the Northeast? We have customers across the nation. Again, typically more focused in deregulated energy markets for both power and gas than in markets where only gas is deregulated. But even so, I would say across the board. As you know, many companies have themselves developed nationwide manufacturing activities. So we then help them with wherever they happen to be based. So as far as we buy gas as far as Nevada and all the way up to Chicago and any other place in the States that you can think of. And the last question that I received here is: what type of customers does ENC typically work for? Well, I would say ENC works only for the bigger energy consumers. But with big, we mean as soon as your energy budget starts hitting $1.5–2 million per year, and anything up from that level. Our main group of customers find itself back in categories between, let's say, a very broad range of between $2 million and $200 million spent on energy on an annual basis. So there is one criteria, I would say: your consumption needs to be considerable, because that allows you access to a market of flexible contracts, which in essence are hedging instruments that you get as a service from your supplier, and that you can use without having to make it more complicated than needed. As far as I can see, these are the questions that were asked during my session, so that were asked offline. Ben, did we receive any other questions now? Are there any raised hands?
Kobe, we received one additional question.
Yes.
From Toliver Rep. He asks, do you work in the diesel and coal markets?
With the procurement, I would say that is somewhat more difficult. Typically, diesel and coal markets are more local markets where you have to go out and find the suppliers who are ready, who are able to supply the commodity locally to your site. So we do help our customers, though, setting up hedging strategies or risk management strategies for that commodity as well. Again, when it's considerable enough, the volumes need to be, specifically for those volumes, need to be definitely big enough before you can really apply risk management. But if they are, there is no difference between natural gas and power, and on the other hand, some other commodities that companies end up buying. I would say natural gas and power are even much more easy to do because the suppliers are very often themselves nationwide active and have created services within the framework of their supply contracts that really allow you to benefit from this, because they are providing you hedging instruments without having to go to a third party. So you can actually use your supplier almost like that third party, a bank or other, to execute your risk management with the added advantage that you don't need to. You're essentially making price locks through your supplier. It's your supplier who does hedging in the background, but it's not you who are executing hedging. So with all the advantages that brings. So I would say, yes, we can do that, but the volume will be important in the case of coal and diesel. If that is the last and the only question, Ben, then I propose to terminate this webinar right now. But not without thanking everybody for participating today. I hope it was insightful and I hope you learned something. If you do have any additional questions, please feel free to reach out to us at any given moment in time. We are open to talk to you and to answer all of your individual questions. Again, this presentation will be made available to all of who participated in this call. And I'm looking forward to talk to you in the future personally. So thank you for your presence today, and looking forward to speak to you later.